As you step into your 30s, get ready for some major changes in your personal and work life. These changes can have a big impact on your money matters. It's a time when people often settle into their careers, start families, and make big purchases like houses or cars. But be careful, because along with these exciting milestones come some money traps you should avoid. To help you sail through this phase with financial confidence and stability, I've identified 6 traps that you need to watch out for. By recognizing and steering clear of these pitfalls, you'll be setting yourself up for long-term financial success. So let's take a look at these 6 traps and how to avoid them. Number 1. Living beyond your means. Imagine this. You're in your 30s, and your income is growing. It's normal to feel excited and want to treat yourself to nice things. But here's the catch. Be careful not to spend more money than you actually have. It's like buying things that are too expensive for your budget. When you live beyond your means, you end up with a lot of debt and financial problems. That's not fun at all. So what can you do to avoid this trap? Well, you need to create a budget that works for you. This budget should consider how much money you make, how much you spend, and your financial goals. Instead of spending money on unnecessary things, try to save and invest your money wisely. It may not seem exciting at first, but trust me, it's important. By living within your means, you're building a strong foundation for your financial future. So, be smart about your money and make sure you're not overspending. Your future self will thank you. Number 2. Ignoring retirement savings. Saving for retirement is really important, even if you're in your 30s and retirement feels far away. The sooner you start saving, the better it is for your future. If you wait too long, it becomes harder to save enough money. Here's why saving early is crucial. When you save money, it can grow over time. This growth is called compounding. It means that not only do you earn interest on the money you save, but you also earn interest on the interest you've already earned. It's like a snowball effect, and the longer you let it roll, the bigger it gets. To start saving, you can contribute to a retirement account like a 401(k) or an IRA. These accounts have special benefits that help your money grow faster. If your employer offers a retirement plan, like a 401(k), it's a great idea to take advantage of it. Some employers even match your contributions, which means they'll add money to your account based on what you save. That's like free money. By saving early and consistently, you give your money more time to grow. Even if you can only save a small amount right now, it can make a big difference in the long run. The key is to start as soon as possible and make retirement savings a priority. Number 3. Failing to establish an emergency fund. It's really important to have some money saved up for emergencies, like when unexpected things happen, such as medical bills or car repairs. If you don't have an emergency fund, you might find yourself in a tough spot, having to rely on borrowing money at high interest rates to pay for these unexpected expenses. Here's what you can do. Try to save up enough money to cover 3 to 6 months' worth of your living expenses. It's a good idea to keep this money in a separate savings account that you can easily access when you need it. This emergency fund acts as a safety net for your finances, helping you avoid getting into debt and keeping you financially stable during difficult times. Having an emergency fund gives you peace of mind because you know that if something unexpected happens, you have the money to handle it without going into debt. It's like having a backup plan for your finances. So make it a goal to save up for an emergency fund and keep adding to it whenever you can. Number 4. Carrying high-interest debt. Having high-interest debt, like credit card balances, can really slow down your financial progress. The longer you have this kind of debt, the more money you end up paying in interest, and it becomes harder to reach your financial goals. Here's what you can do to avoid this problem. Make paying off high-interest debt a top priority. Start by creating a plan to repay your debts. Focus on the debt with the highest interest rate first, while making minimum payments on your other debts. This is called the debt avalanche method. By tackling the highest interest debt first, you save more money in the long run. As you pay off each high-interest debt, take the money you were using to pay it off and put it towards the next debt with the highest interest rate. Keep doing this until you've paid off all your debts. It's like a snowball effect, where your payments gather momentum and become bigger over time. Alternatively, you can use the debt snowball method. This means you pay off your debts starting from the smallest balance first, regardless of the interest rate. This method can give you a mental boost and a sense of accomplishment as you eliminate your smaller debts quickly. It helps build motivation to keep going. The key is to be consistent and keep making payments to reduce your debt. By paying off high-interest debt, you save money on interest and get closer to your financial goals. So, make a plan, stick to it, and watch your debt shrink over time. Number 5. Neglecting insurance coverage. As you get older and take on more responsibilities in your 30s, it's really important to have the right insurance coverage to protect yourself and your loved ones. If you neglect getting insurance, it means you're taking big financial risks if something bad happens, like getting sick or injured, or if there's damage to your property. Here's what you can do. Take a look at the insurance policies you already have and make sure they provide enough coverage for your needs. Depending on your situation, you might need different types of insurance, such as life insurance, disability insurance, health insurance, home insurance, or auto insurance. Life insurance can help take care of your loved ones financially if something happens to you. Disability insurance can provide income if you're unable to work due to an illness or injury. Health insurance helps cover medical expenses, while home insurance protects your house and belongings from unexpected events. Auto insurance is important to cover accidents or damage to your car. Having adequate insurance coverage gives you peace of mind. It means you're prepared for unexpected situations, and you won't have to worry about the financial burden they can bring. Insurance is like a way of managing the risks that come with life, so you can protect your finances and have a more secure future. Number 6. Delaying major financial decisions. When you're in your 30s, you'll likely face some big life changes, and it's important not to put off making important financial decisions. Delaying these decisions can cause you to miss out on opportunities, pay more money in the long run, and feel more stressed about your finances. Whether it's buying a home, paying off student loan debt, saving for retirement, or starting a family, it's crucial to carefully think about the financial impact and make timely choices. Here's what you can do to avoid this problem. Start by setting clear financial goals for yourself. What do you want to achieve in the short term and the long term? Once you have your goals in mind, develop a plan to reach them. This plan should outline the steps you need to take, like saving money, paying off debt, or investing. It's also important to stay informed about the trends in the market and educate yourself on personal finance topics. The more you know, the better decisions you can make. Thank you for watching. Your 30s are a crucial time for setting yourself up for long-term financial success. By avoiding the 6 money traps we discussed, you can take control of your finances and pave the way for a prosperous future. Remember to live within your means, meaning spend less than you earn. Prioritize saving for retirement and paying off high-interest debt to secure your financial future. Build an emergency fund to protect yourself from unexpected expenses. Ensure you have adequate insurance coverage to safeguard your financial well-being. And most importantly, make timely financial decisions, staying informed and seeking guidance when needed. With foresight, discipline, and a commitment to your financial well-being, you can thrive in your 30s and beyond. Don't forget to hit the like, subscribe, and share button to stay updated with more helpful tips and advice on personal finance. Thank you again for watching, and I'll see you in the next video.